and welcome to the latest European Parliamentary Research Service Policy Roundtable. We're hitting the ground running this year by looking at the economic outlook for 2021. And we're very privileged to have with us for this purpose the Chief Economist of the World Bank Group. Carmen Reinhart became Vice President and Chief Economist of the World Bank in June last year. So she entered the fray at a critically difficult moment for the world economy. She manages there, among other things, the Development Economics Department of the World Bank, with which EPRS and other services in the European Parliament have been developing a very close relationship in recent years. Her areas of expertise are international finance and macroeconomics, and she's on public service loan or leave from the Kennedy School of Government at Harvard University, where she is professor for the international financial system. She's previously been at the Peterson Institute, professor of economics at the University of Maryland, and served on the advisory panels of the Federal Reserve Bank of New York and the International Monetary Fund. She's also famous for her analysis of the global economy in terms of the potential implications of debt overhang, which has made a very substantial name for her in the academic and public policy world. She's going to be introduced by our Vice President with special responsibility inter alia for relations with the World Bank and the IMF, Pedro Silva Pereira, MEP. He's been a member of the European Parliament since 2014 and is Vice President, in addition to his IMF and World Bank responsibilities, for the Parliament's budget, for the European Citizens Initiative, for neighbourhood policy, and a number of other areas. He's a member of the Parliament's Economic and Monetary Committee and also its Constitutional Affairs Committee. From 2002 until 2014, he was a member of the Portuguese Parliament, serving as Minister for the Premiership between 2005 and 2011. It's a great pleasure to welcome both of our keynote speakers, and they're going to be followed to get the discussion going and to open out after that to question and answer from the digital floor by three prominent economists from various think tanks. Maria de Mertzis is Deputy Director of Bruegel, the Brussels-based economic think tank, and she's a regular visitor to our EPRS events. Delighted to see you, Maria, on this occasion again. Lars Brusos is Senior Fellow at the German Institute for International and Security Affairs in Berlin, SWP, the well-known strategic and foreign policy think tank. Before doing this, he was the director of a collaborative research centre, 700 Governance in Areas of Limited Statehood, New Modes of Government at the Free University of Berlin. And he's also been a political advisor in the German Bundestag. And we're delighted that you've been able to join us for the first occasion for such an EPRS event. And last but not least, Nicholas Velh, who is an aficionado both of the Brussels scene and indeed the Washington scene, because he serves simultaneously as a senior fellow both at Bruegel on the one hand here in Brussels and at the Peterson Institute for International Economics in Washington, DC. He has also joined us on previous occasions, and as always, it's very nice to see you, Nicola. So, without further ado, I'm going to ask our Vice President, Pedro Silva Pereira, to set the scene for the outlook of the global economy in 2021 in the context of our increasingly close links as an institution and as a parliamentary research service with the World Bank. Over to you, Vice President Silva Pereira.
Okay, thank you. Good afternoon, Anthony, and good afternoon to you all. I would like to start by wishing you all the best for this new year, hoping that we can all overcome the difficulties that still lie ahead of us. I want to welcome you also in this joint event between the European Parliamentary Research Service and the World Bank, and to thank the EPRS for the kind invitation to open this discussion. This is one of the first events organized by EPRS this year, after we ended 2020 with an interesting roundtable with the director of the European Department at the International Monetary Fund. It is now particularly significant that we welcome for the first time Mrs. Carmen Reinhart, the new Vice President and Chief Economist at the World Bank Group. For this reason, I want to thank Mrs. Reinhart and the World Bank for taking the time to present its views and outlook at this conference. I must say that it is also a great pleasure to receive our distinguished guests, our guest economists here in this session. Of course, it is safe to say that we would all prefer to have this discussion in happier times, in the presence of each other, but unfortunately, due to this situation, the circumstances force us to hold this event in this virtual format. I hope, nevertheless, that we can have a fruitful discussion. The relations between the European Parliament and the World Bank are of close cooperation, and as Vice President in charge of these relations, I must say that our aim is to making them even better. I sincerely hope that events such as today's event can make those ties stronger and are able to provide an excellent reference and knowledge for the members of the Parliament, providing us with insight and forecasts, analysis, and a global overview of our current economic situation. As you know, the EU and the World Bank first signed a framework agreement of cooperation back in 2001. The new cooperation agreement signed last summer is an update and in fact, an expansion of a previous agreement already dating from 2016, and sets the modalities through which the two organizations work together. The Financial Framework Partnership Agreement enables the parties to enter into a long-term cooperation that involves innovative instruments and cements our relationship with mature partners such as those of the World Bank. One of those instruments is the Europe 2020 Programmatic Trust Fund, which was established to allow the European Commission to avail itself of the World Bank's technical assistance and analytical and policy work for the purpose of pursuing the goals of Europe 2020, which is, of course, the EU growth strategy that is now being applied. The program management is based in Brussels, and I'm happy to say that its establishment, since its establishment in 2012, it has received around 25 million euros in EU contributions from various European Commission directorates. The cooperation between the European Union and the World Bank have together helped, I think it's fair to say, millions of people around the world to live better lives and allowing us to tackle the biggest challenges of our times. Now, we know that the World Bank's most recent projections, and about which, of course, Mrs. Reinhart will give a deeper insight, say that following the last year's collapse, global output is expected to expand around 4% this year, if we can confirm that. Unfortunately, these figures remain well below pre-pandemic projections, and we also have to take into account the downside risks, which of course include the possibility of further resurgence of the virus, and in fact we are already witnessing that. Vaccination delays, more severe effects on potential output from the pandemic, and bigger financial stress. So policy actions will for sure be needed to provide the necessary economic and financial stimulus in order to boost real economy, taking advantage also at the European level of the fiscal relaxation measures adopted here. This means, and this is the most important message perhaps, that we really need a proper alignment of expansionary monetary policy with expansionary investment and fiscal policy. As the World Bank rightly points out, comprehensive policy effort is needed to ensure robust, sustainable, and equitable growth. A package of reforms and increased investment in human and physical capital would for sure help to tackle also inequalities and avert the expected impact of the pandemic on potential growth in emerging markets. As the World Bank Group President David Malpass said recently, making the right investments now is vital, both to support the recovery when it is urgently needed and foster resilience. Our response to the pandemic crisis today will shape our common future for years to come. Now, the coronavirus disease pandemic is exacting a severe social and economic toll. Almost 100 million people have contracted the disease globally. More than 2 million of them died. Millions of jobs, of course, have been lost, and the governments were forced to increase their national debts to unprecedented levels. This year started with positive news, with the first phase of the vaccines being rolled out to the first-line respondents, healthcare workers, and people in need. Nonetheless, despite this more positive horizon, countries across the world are again facing the necessity of hard lockdowns and a second, third wave of confinement. Without any surprise, this has led to a record downfall in economic activity. Governments face the unbearable choice of restricting social and economic life, which depresses the economy, or introducing only light preventive measures, which of course might be good for economies, but poses a risk to our healthcare systems. In any case, the ongoing resurgence of infections and the pace of the vaccination presents the biggest uncertainties in the near future and is the greatest downside risk at this stage. The main concern, however, must be to ensure that the vaccines will be distributed equally among rich and developing countries, and on a European perspective, that we continue to have a coordinated response. This is what the European Parliament is calling for. The virus knows no boundaries and needs to be fought everywhere with the same intensity. Even if times are still of uncertainty, what we can already recognize, I believe, is that the pandemic toll on Europe could have been much higher without the robust and comprehensive response to the crisis. Europe's policy response to the pandemic was being unprecedentedly strong, and across Europe, governments deployed large fiscal packages to support households and firms, with job retention programs preserving at least 45 million jobs. As we have discussed in the last roundtable, of course, central banks embarked on substantial monetary easing through both conventional and unconventional means to support the flow of credit and prevent financial market disruptions. Furthermore, the European Union relaxed, as I mentioned before, existing rules to accommodate increasing fiscal deficits. And we all seen the mobilization of supranational resources. We also had the good news of an agreement on the financial package for the near future in Europe, which is, of course, very important. The end of the year also brought some positive signs that we have to acknowledge. On one hand, the EU successfully concluded the negotiations with the UK, finally. This ends a very long and intense period of negotiations between the two parts, which was largely contributing to a scenario of political and economic uncertainty. Secondly, just today, we will witness the inauguration of the new United States President, Joe Biden, and I truly hope that a new leadership in the White House again, based on scientific evidence and common sense, can help in providing a more coherent international combat against the virus and hopefully return to the rules-based international order and multilateralism. It is particularly relevant that the US goes back to the arena of multilateral cooperation and towards international cooperation amidst this pandemic, engaging in the issues like climate change, but also World Health Organization and the World Trade Organization. Let me mention, to conclude, the Portuguese presidency of the EU that is just starting, and even today we had here in the plenary of the European Parliament the Portuguese Prime Minister Antonio Costa. While the Portuguese presidency is committed to lead our Union into this path of strategic partnership, not only with the United States, but also with other important regions. It will be important to see the results of the summits that are bound to take place with India and possibly with Africa, two key regional actors with which the EU must seek a fruitful and close cooperation. It will also have the important task of starting to build this new relationship with the UK after the agreement of Christmas Eve. But let me underline, perhaps quite a Portuguese tone, that for the next 6 months, Portugal will have the presidency of the European Union, but also the Secretary General of the United Nations, Antonio Guterres. So it is a great opportunity for relaunching multilateralism, and for sure we need that in the world and also for Europe's future. The Portuguese presidency is also, of course, very committed with green, digital and fair recovery. We will have an important social summit in Porto in May to deepen our European pillar of social rights. And we hope to launch finally the conference on the future of Europe to discuss with citizens the future of the European Union. Finally, of course, we will do our best, the Portuguese will do our best, the Portuguese presidency, so that the money will reach the real economy, so that the European funds that were agreed during the German presidency can finally reach the real economy. So to conclude, we have to be focused on limiting the spread of the virus, overcoming the vaccine-related challenges, providing immediate relief for vulnerable populations, and setting the instruments, the economic, financial instruments for a quick economic relaunch. This is for sure one of the most challenging periods in contemporary history. The work being developed by the institutions coordinating our response to the pandemic and seeking to avoid unnecessary competition among EU member states show us once more the importance of this union. Despite the horrible consequences of this crisis in all aspects of our lives, let's remember that we stand stronger and united. Thank you once again for your participation at this event. Discussions such as this, I believe, are the right contributions to help us find the policies we need. Thank you very much.
Thank you so much, Vice President Silva Pereira, for those introductory and scene-setting remarks, which we greatly appreciate. And for Professor Carmen in Washington, who's perhaps not so familiar with the way the Parliament works, the background noise was not the fire alarm going off in the European Parliament building. It was the fact that the plenary session of the Parliament is about to resume. And as you can see, as a Parliament, we tried, notwithstanding all the difficulties, to keep business as usual wherever we can in the current crisis. So, without further ado, over to Professor Reinhart to share her insights into the outlook for the global economy. As you probably know, as you certainly know, but as the people listening perhaps are not aware, earlier this year, the the World Bank issued its regular Global Economic Prospects document, which sets out its projections for the future. That came out on the 5th of January, and so they're really bang up to date. And Professor Reinhart's going to share some of the thinking and analysis behind that and give her own personal view as to some of the issues that the current crisis and hopefully the recovery offer and represent. Over to you.
Well, first of all, thank you so much for having me. It's a real pleasure. And I look forward to continuing this relationship in the future. You know, our work in development economics group really thrives on this kind of interaction. So what I would like to do is in the next 20 minutes or so address very much, as you said, here are some of the big picture elements of the coming year, the global economic outlook. Talk a little bit about issues that are cross-cutting, meaning advanced economies, emerging markets, and low-income countries as well. There are some issues that are obviously cross-cutting. And then I know your group is very much also interested in medium-term issues. So not, you know, looking beyond the more immediate horizon, but also what I think some of the medium-term big policy concerns are going to be. I'm going to focus there more on in connection with the bank, you know, some of the issues facing, you know, the member countries dealing with the legacy of COVID. And that legacy, well, there's obviously, and I will talk about it, hopefully I will have a little time in the end to also talk about vaccines and what's being done on the climate change agenda at the end, but let me progress on the outlook also with sharing with you all, and again, welcoming feedback. We just discussed in the board, in the World Bank board yesterday, the World Development Report, which was shared with all of you. And we are planning next year. And some of the things that I am going to talk about are also some of these legacy issues that we would like to address in the next World Development Report. So your input is very timely and welcome. So let me start on the cross-cutting issues, that the kinds of things that, you know, one loses sleep over. And there are many these days. As you noted, the global economic prospects is looking for a 4% growth rate for the global economy. However, what is really unusual, if you will, about not just the World Bank forecast, but any forecast in this environment is dispersion. The fact that the uncertainty surrounding any point estimate is exceptionally large in an environment in which, in a good scenario, if the rollout of vaccines, you know, goes smoothly, if the pandemic is curtailed and we don't continue to get waves, 4% may be a low number given the magnitude of the collapse we saw last year. However, in a scenario where the rollout of vaccines falls short of expectations, you know, we had this later wave that's hit Europe, it's hit the US, in that kind of environment, growth could be less than half than 4%. So I think a big takeaway is that, you know, in a reasonable scenario, that's the point estimate, but there's huge uncertainty. Second important message, and I've been driving this since the summer, really, well before the global economic prospects came out, is don't confuse rebound with recovery. You know, we've seen country after country historic collapses in GDP in 2020. So of course, you're going to get a rebound in GDP growth, in industrial production, and employment. You're going to get a snapback, but that's rebound. Recovery, you know, in a very minimum minimorum definition of recovery, is that you will be as well off as you were before the crisis, right? You know, per capita income is at least what you had before the crisis. That's a minimum minimorum definition of recovery. That's going to take years in the global economy. So even if we get the 4%, we're really looking at a scenario in which by 2025, this is based now on the world development, I mean, the global economic prospects doesn't go as far out as the World Economic Outlook of the IMF, which goes out to 2025 horizon. Even in a fairly optimistic scenario, a quarter of the countries in 2025 will still have per capita incomes below what they were in 2019. So here is, you know, I think a challenge. There are big legacy issues, and we're going to talk about some of those legacy issues next. I said that one of the things I wanted to focus on in this discussion, and I sent all of you a couple of links to recent pieces that I did for the Economist on the world in 2021, a recent Project Syndicate piece, and this focuses on some of the legacy issues on the financial sector as it affects households, as it affects firms. You know, during the pandemic, we've had, as you know, has been already discussed by Pedro and by yourself, an equally historic policy response in terms of monetary stimulus from the major central banks and from a lot of the emerging market banks, central banks as well. This is, you know, quite unprecedented. Very much counter-cyclical monetary policy, very much counter-cyclical fiscal policy. And I'm going to turn to both of those next. But we've also had an exceptional contribution in terms of counter-cyclical policy from the financial sector by way of grace periods offered to households and firms during the pandemic to deal with a temporary liquidity crisis. So a lot of repayment of household debt, a lot of repayment of, you know, business, small and medium enterprise debt has been placed on hold. And this has been a response really across countries, cutting, you know, from low-income countries to middle-income countries to the advanced economies. This has been part and parcel of that macro policy response, beyond fiscal, beyond monetary. And I think it was a very helpful, well-placed policy to provide liquidity and inject, you know, cash flow relief at a time when it's sorely needed. However, the big question and challenge that I write about that is likely to be a headwind for growth as we look ahead is that, you know, historically, as you know, a lot of my work is very focused on long-term historical patterns, recurring stylized facts that we see time and again. And one of those stylized facts that I'd like to flag is it's very difficult to see output declines, let alone output declines of this depth and this duration without serious consequences on financial sector balance sheets. Households that have lost their jobs and have difficulty repaying debts taken on prior to the pandemic. Small and medium businesses in the entertainment area and the retail area that have been especially hit hard by the longevity of the lockdowns and the irregularities that here we are more than 1 year later and we're still in them. So what I am concretely getting at is financial fragility. And this cuts countries in different degrees, but it's advanced economies are certainly not immune to it. Europe is not immune to it. The US is not immune to it. It's a legacy of the significant shock, real shock to output, employment, and several sectors of the economy, like tourism, retail, entertainment, to name a few. So, what I'm suggesting here, as you asked very candidly, what's your outlook? What are the kinds of things you worry about? I worry, and this is not, melodrama that we're going to have a Lehman moment, or, like in 1979, Paul Volcker raising rates and, triggering a major debt crisis at the drop of a hat among developing. I'm not talking about that kind of drama. What I'm talking about is what I call the quieter financial crisis that nonetheless means that balance sheets of financial institutions, notwithstanding the fact that many of those financial institutions were in very good shape before COVID hit, unlike 2008, 2009. But that, the duration and severity of the shock undermines the capacity of many of their corporate and personal clients to repay their debts. And furthermore, that the grace periods, the suspension of debt repayment that we've had are, for the moment, hiding what are non-performing loans. In other words, I think we have a real challenge disentangling illiquidity from insolvency at the moment. That it is very difficult at this moment to single out, okay, these firms are really going to make it, these are not, and that we may have, as a consequence, what in the context of Japan's famous banking crisis of the early 1990s, a lot of zombie lending. Again, you don't need the drama of a Lehman moment. You don't need to have, the kind of paralysis in financial markets, albeit although temporary, that it was at the height of the 2008-2009 crisis, and that we also saw in March, April of last year. We don't need that to have a situation where financial institutions have more impaired lending, more rollover of bad debt. They're also buying more securities from the government, right? So bank balance sheets increasingly are absorbing the rising issues of government debt, rolling over a lot of pre-existing debts that are in good portion non-performing. And does this sound familiar? Well, it should, because this is a lot of what created a credit crunch in Europe after the 2008-2009 global financial crisis, and a credit crunch that persisted for quite a long time. This is an issue that is faced by, as I said, the most, I would say, salient example in among the emerging markets is India, which, unlike many of their advanced economies and developing counterparts, did not start from a solid basis in terms of bank balance sheets. They were already, you already had a lot of non-performing loans. You had a lot of financial sector weaknesses, and so I don't want to be overly negative, but I think when you asked me what do I worry about in that 4%, number one, the issue of the pandemic, how quickly or how slowly, vaccines. So the first concern is, what is the path of the pandemic? Second concern I have is that growth will have a lot of headwind from some of these balance sheet effects that I am talking about. And a very big source of concern is that those balance sheet effects are very regressive. This has been a very regressive shock. It's hit low-income countries especially hard. It's hit the most vulnerable within the wealthy economies the hardest. So it's a very unequally distributed crisis. As we look to 2021, because I think one should not confuse rebound with recovery. I think more stimulus is still very much needed. Especially given the fact that whether you at this stage call them second or third waves of the pandemic are still with us. Now, what I at the World Bank see is, of course, that ability to provide stimulus is shrinking, if not outright disappeared, in a lot of the emerging market economies, where they already entered the COVID crisis with compromised balance sheets and now I'm talking about governments, not just households and firms, but governments that look, among the IDA countries, the 73 low-income countries that make up IDA, more than half of them are either in debt distress or rated as having a high vulnerability to debt distress. And that brings me to, a second topic that I think is also another headwind for the global economy. I talked about the balance sheet, the quiet financial sector problems. But I think a second headwind is the emerging market situation, and that is night and day from the 2008-2009 crisis. Okay, in 2008-2009, we called it a global financial crisis, but it was really a crisis in about a dozen advanced economies that had financial excesses and bubbly property prices. It wasn't a crisis that was truly global in that China was growing in double digits. Because China was also growing so rapidly, commodity prices remained vibrant during the 2008-2009 crisis. And the combination of Chinese growth, high commodity prices, and low global interest rates was a really, important source of the engine of growth for the developing and emerging market world, which grew very, very vigorously between 2003 and 2013, and only really started slowing down significantly in 2015 after commodity prices started to crack and China's growth more than halved. So a second big source of concern, apart from the financial fragilities, is that many developing countries and emerging markets are in really bad shape at the moment in terms of their ability to deal with the pandemic is limited by lack of fiscal space. And many of these are either in or will be in shorter order facing debt problems. This is a big issue at the bank. We spend a lot of time, on these very issues of how do you deal with countries to avoid falling into the trap of the 1980s, where you get a debt restructure, but it's not enough. And then 2 years pass and you need another debt restructure. And so you go on and you have a decade of lost crisis, of lost decade for development, which brings me to what this really does for development. And it is a major setback. The Poverty and Shared Prosperity report that we prepared later last year showed the first spike in global poverty since the late 1990s. The pandemic has had big legacy effects on poverty, on inequality. I mentioned that this is a very regressive shock, and on debt. And those three things are interrelated, because with debt problems, what governments can do, especially middle and low income countries can do to alleviate poverty and to level the playing field in terms of more cash transfers and the like for given the unequal effect of the pandemic on households, is certainly more limited. But let me not end in such a downer. I did want to put on the table the concerns that I had on financial fragility and on especially the public sector finances in many, starting with the canary in the coal mine, with the low income countries, where weaknesses were already there. But I think where the World Bank is very energized going forward is in the Building Back Better agenda, which, again, tries to deal, but this is not new to the bank. This part, it tries to deal with the poverty issue, tries to deal with the inequality issue. But I think there is new energy on Building Back Better also in terms of climate change, and using the crisis as an opportunity, to encourage governments also to, eliminate the kind of subsidies that, are energy subsidies, to use the crisis to move to also greener financing. I think there is, there's a new initiative. There will be a new paper from the bank outlining the strategy, which we're very excited about. It should be something for the next annual meetings, that also, looks at strategies to encourage and the role of the bank in encouraging greener investment. As I mentioned, there's a significant amount of work on what the best way of phasing out or eliminating a lot of the energy subsidies. I think where and I would love to see more work on this, we need to do is link the debt problems that I was talking about to the important climate change agenda. During the 1980s, we had debt for nature swaps that were not particularly successful. You know, they were very limited in scope. There were issues raised about moral hazard. I think we have to revisit that area. How do we attract finance in a way that some of the debt overhang can be restructured in ways that you know, facilitate green investment. And so that is one area where I think there's much promising work to be done and being undertaken at the bank. I think, you know, the legacy issues from the COVID pandemic on development should not be underestimated. I'm offering sort of my final observations. Should not be, you know, underestimated. I think the development setback is very real. It's a setback in poverty levels. It's a setback in inequality. It's a setback in public finances, so the governments can do less. It's a setback on some of the big financial. I mean, a lot of the unification, the Ball agreement that, you know, where it had increased financial transparency and accountability. I think in emerging markets, we're also seeing setbacks in that dimension. But I think one also, you know, it's often said one should not waste a crisis. And I think, you know, this really also sets the stage for the building back better. And I think, you know, the bank's portfolio in terms of you know, its allocation towards you know, green investment projects and financing climate change, especially in West Africa, but not exclusively, extensive programs in Bangladesh, you know, coastal erosion and all kinds of, that portfolio and that shift is very real. And I think that, you know, has, you know, very, bodes well, because this is not an either or. If you look at the Poverty and Shared Prosperity report that I mentioned earlier, a lot of the deterioration in measured poverty also correlates to, you know, the C's, you know, conflict, climate change are big factors, and I think, you know, there's sort of a new you know, enthusiasm to use the crisis as an opportunity to further that agenda at the bank. And let me stop there. I've tried to give you an overview of the big picture, you know, the shorter term concerns, more medium term concerns, what some of the bank's thinking on these different areas are, and let me stop there.
Well, thank you very much indeed, Carmen, for that extremely interesting, very thought-provoking, very sober, but I think very realistic analysis, and one which I think policymakers really appreciate as they try to delve into this issue and think through its implications, both short, medium, and long term. So thank you for that, and some very powerful takeaways. I'm now going to invite Maria de Mertzis, Deputy Director of Bruegel, to come in and give both her reaction to what Professor Reinhart has said and her own appreciation of the situation. And given that we've got just over, I would say, just over 40 minutes for the remainder of the discussion, please do try and keep your, and all other speakers indeed, remarks fairly succinct, because I would like also to pass over to give the digital floor an opportunity. We've already received a couple of questions by back channel, but please feel free to use the chat function if you have a question, and I'll try and cover as many of those questions posed as possible towards the end of the discussion. So over to you, Maria.
Thank you so much, Anthony, and a very big thank you for the invitation, Vice President Silva, Pereira, Professor Reinhart. Thank you so much. It was really, as Anthony said, sober, but I think a very realistic assessment of what really is going on. The first thing I'll say is that, I mean, I'm always very disappointed at how much inequality at the global level really is, at the smallest of shocks, is the first one to take the hit. And you know, the spike in poverty that you mentioned really is very disheartening. And, you know, I did a very quick exercise just the other day, try to plot the degree of vaccination that we are seeing against per capita income. And here, even at this very early stage of vaccination, the correlation between the two really is extremely disheartening. Just even now, where the data on vaccination isn't all that big, you really see that the richer countries are able to respond much faster. And therefore, you know, that simply is a signal of proliferation, a sort of self-reinforcing of tendencies and trends. Always a very disheartening thing to realize, and one that would be important at some point to break through at the global level. You will allow me to say some of my comments on the EU rather than on the global level, because that's what I know the best, and you know, to offer anchor my comments on some of the things that you said, and then just give you my view on this. I mean, the first thing I'll say is how much I agree with the first point. I'm not going to say the irrelevance of forecasts, but I will more or less get there, I think. I think this is the one time, I mean, we can talk about this in broader sense, but I think the one time where point forecasts really are not informative, simply because of the uncertainties that surround them. And that's important, particularly for policymakers, because, you know, in policy, we typically design our policies based on that point forecast. It is some sort of an average, some sort of what do we think will happen? What is the most likely thing to happen? Well, that most likely thing to happen now has got a very small probability, or, you know, we don't even know what this probability is. So I think it's important not to talk about point forecasts. But then the question is, if we don't talk about point forecasts on which to base our policy, what do we do instead? And here I think is what's important is to go back and see what is it that we want to be prepared for. This has got to be the principle more now than ever. What types of outcomes do we need or do we want to be prepared for? Because everything that you discussed and everybody's discussing and the European Parliament continues discussing is the risks. It's all about the risks and how we want to be prepared for them. And you know, once you sort of, you know, identify these types of events I want to be prepared for, then we need to understand what are the tools. And you know, a lot has happened. The reactions, and certainly by comparison to the financial crisis, the reaction certainly at the EU has been massive. The policy response at the country level, but also at the EU level, from all institutions with old and new tools has really been impressive, nothing short of impressive. And I think it's important to understand that we have done a lot. But we have one more tool to use to deal with economic outcomes, and that is vaccination. Vaccination is not just a tool against the pandemic, which it is, of course, first and foremost. It is also a tool for the economy, and I think we need to try and sell it that way. I mean, the quicker we can persuade our population that this is a safe vaccine, and the quicker we can organize the quicker we can produce it, and the quicker that we can organize ourselves against the vaccination, the quicker we can start looking back at point forecasts, and you know, design policy with the slightly more traditional tools. And I think this is important because even in worlds, you know, the developed world, the EU world, where information is abundant, where we don't rely on fake news, when we rely on science, the public has not really bought as much as I would have liked to have seen the idea of quick vaccination. And I think that there is a lot to be done there, which has got to do also with communication to try and persuade the public to go ahead. Then the second thing we need to think about is the exit strategy. We have done so much. The monetary policy, I mean, the QE and the pandemic programs, the fiscal side, all the guarantees that the European countries have given. At some point, we will need to stop and be reverted. That's an exit strategy. And, you know, at this point where we have to not only think about the exit strategy, but implement it, is not very far from now. And I'm hoping it is quick enough. But, you know, we need to think of how are we going to reinstate state aid rules? How are we going to go back to the fiscal compact in the current form or possibly in a new form, better form that allows for the needs of investment? How are we going to remove the support on labor and the support on firms? We need to think about this now because we will need to implement this soon enough. One last point, if I may, if you allow me, Anthony, and then we can take it up in discussion on other things. Carmen talked about financial fragility, and she also said that the EU is not immune to it. I would like to provide some evidence for this, because I think that's a very important thing. The first thing exercises, one of the first questions that we asked the moment we entered the first shutdown is, well, can the households manage? And I'm asking about EU households. So how can we manage? And you know, much to our surprise, as we came into the pandemic, and despite all the support that is given, 1 in 3 households self-assess themselves as being financially fragile. What that means is that they wouldn't be able to meet a medium-sized unexpected expense, things like a sudden funeral or an emergency surgery, these types of things. 1 in 3 households on average, with actually significant differences between countries, going all the way up to 1 in 2 households in some countries, would be unable to hold to meet. So in other words, they had not enough what I call liquid savings, is they could draw upon to meet this. So, you know, I would just wanted to second this issue, that the issue of financial fragility certainly on these households is not a theoretical concept. It's a real concept that we need to be prepared of, and not just in the developed world. I wanted to say something about the US, because as we speak, but perhaps we can come back to this in the discussion.
Thank you very much indeed, Maria. And I was going to, in the discussion, if we have time, also ask Carmen if she has any views about the evolving scene in the US. And we're only just over 2 hours away from a new US president. So it's very exciting. And your philosophy of Build Back Better is not only a global one, but also a domestic one. Now over to Lars Broses, who's Senior Fellow at the SWP think tank in Berlin. Lars.
Okay, thanks, Anthony, so much. Thanks for having me, of course. I think I'm going to start off with a remark about finding solutions for the immediate economic problems the world is facing in the pandemic. That, I would say, is the task of the economic experts, and I happily cede the floor to them. Finding solutions for the early detection and hopefully prevention of major global disruptions. That is the task of experts for anticipatory governance, and that is where I come in, I think. So why is this important in a conversation about the global economic outlook? Well, I think because global disruptions tend to have adverse effects on the global economy. It is hardly surprising that in the pandemic, policymakers are pressed to react to the shortages of crucial medical equipment in parts of Europe and the US because of disrupted supply chains and the concentration of production facilities in a few countries, thankfully only temporary. But of course, this lends further credibility to talk about decoupling and strategic autonomy. So I want to start with taking 2 issues out of the conversation we've had so far, and that is the issue of forecasts and the issue of taking the crisis as an opportunity. Why were we surprised, or why were we unprepared for the pandemic? Was it a lack of warnings? Definitely not. I mean, you know about the famous Bill Gates TED Talk, you know about the World Economic Forum's global risk reports that all outline that there is a certain risk of a pandemic in the next few years. And you could add to this numerous warnings by the UN, by researchers of all kinds. So it's not a lack of warning. So maybe it's the inadequate policy instruments or insufficient resources. And that's really not the case as well, because we have a lot of experience with handling infectious virus diseases like Ebola, like the swine flu, like the bird flu, SARS and MERS, I could mention here. And it's also not the insufficient resources that we had, because after his TED Talk in 2015, Bill Gates said at the Munich Security Conference in 2017, that the expenses of prevention would amount to roughly $3.4 billion per year, whereas the cost of a full-blown pandemic could amount to $570 billion annually. And that was a very conservative estimate, as we now know. So maybe there's a third reason for the state of unpreparedness, and that could be, is it a novel quality of risk? And again, it's not, because as we have seen, COVID-19 is not a completely new type of virus, because we have been able to really surprisingly fast develop a vaccine. In conclusion, Corona is definitely not a black swan event. There have been a lot of warnings before a pandemic out there. So no wonder why people are asking, if so many warnings were issued and if the cost of prevention was relatively low. Why were we not prepared better? And of course, there are various reasons for this, that policymakers did not take the necessary preparations. But what's interesting here, some of them did. For instance, Singapore, South Korea, and Taiwan, they are really kind of success stories, I would say. And that has a lot to do with their prior exposure to highly infectious virus diseases such as SARS and MERS. In Europe and the US, you know, SARS and MERS did not turn out to be as deadly as expected. So in reverse logic, policymakers did not take the necessary preparations for another pandemic, which in my view links to another interesting question. And that is, how do policymakers set priorities for prevention? What are they focusing on? And they have to set priorities because it is impossible to prepare for all hypothetical risks and eventualities that are out there. There's a lack of attention, which is very important, and there is a lack of resources if you would try to address all of them at the same time. So a typical future heuristic is simply learning from the past or past experience. Technically speaking, that would be analogical reasoning. And that can work, as we have seen in Singapore, South Korea, and Taiwan, but it has its limits, as we know from Europe and the US. So if anticipatory governance is not the priority of policymakers, then they have a point, because quite a lot of warnings of hypothetical risks by experts turn out to be wrong. And the track record of expert predictions is not that impressive, as we know. And crying wolf or raising false alarms has consequences. Policymakers might, by the media and courts of auditors, of course, or the general public, when they invest in stockpiles of, say, vaccines, personal protective equipment, or intensive care units, and the pandemic does not materialize as expected. So this happened in 2009 with the swine flu scare, which is regarded as an example of risk overselling. Not surprisingly, policymakers in Europe and the US learned a lesson that in the end turned out to be wrong, because this time is different. But some predictions are better than others, and you do not need access to classified material to outperform your competitors. In fact, research has shown that the best forecasters of political events can achieve 30% higher accuracy than control groups from the intelligence community. And I think, to come to the end, policymakers could harvest this knowledge to increase the credibility of the decisions to set priorities for prevention, instead of a 360-degree vision of resilience, which is very hard to achieve. It would be possible to make justifiable choices. That should be attractive, shouldn't it? Thank you.
Thank you very much indeed, Lars, for that extremely stimulating intervention. You'll be pleased to know that in the Parliamentary Research Service and with some of our colleagues from other parts of the administration and the Parliament, we've been doing a little bit of the kind of analysis which you describe, and we have recently analysed 66 major strategic risks to the EU as a system, and in 33 cases we identified there as being significant general implications and at the same time a reasonable or high probability that they could occur. And of those 33, we concluded that in 15 cases, the Union neither had the financial nor the legislative authority to act in those fields. So we're doing a little bit of an X-ray of exactly the kind that you're describing to try and get inside these issues, and I'll be more than happy to send you some of the material, and we would be extremely interested to hear your reaction to it. However, the reaction we most immediately want to hear is from Nicolas Velh, who's both at Bruegel and at Peterson, and he's going to give his commentary on what Professor Reinhart said and his own appreciation of the situation. Over to Nicolas.
Thank you, Anthony, and thanks for having me. And picking up on what you just said, I also want to commend the European Parliamentary Research Service for the extraordinary work they have done, largely under your leadership in the last few years, to build up a capacity that was severely lacking before for the European Parliament, also for the European institutions and the Union as a whole, of independent research, forward-looking. And I think the project you just mentioned illustrates that, but also an extraordinary amount of really topical, really independent, precise, useful policy research that your service is churning at a high pace, and this makes a big difference. I think many people outside of the European Parliament community have not yet noticed the amount of good work that you're doing, but they will notice over time, and it's a game changer for the policy debate in Europe. So thank you for that. I will make 3 brief points echoing what some others have already said. One is about uncertainty. I think it is clear that the level of uncertainty is extraordinarily high, and it's not going to lift anytime soon. And if you want to make a thought experiment, let's just go back 6 months in the European context. 6 months is not a long time. And 6 months ago in July, there was a near consensus, near certainty around the European Union in the policy community that the wave of contagion and infection by the coronavirus was behind us. And yes, some people were talking about the risk of a second wave, but that was viewed as very abstract. People were reopening borders, traveling again, and here we are. So let's be very humble about where we will be in 6 months' time, because nobody has a clue. This virus continues to mutate, and the patterns of contagion continue to evolve as we speak. The second point I want to make is to emphasize the extraordinary level of cross-border cooperation that, despite the bad headlines, has actually gone into the reaction to the virus. And I have high expectations and hopes that it will accelerate now with the different US administration. One area which is somewhat invisible but has made a huge difference is monetary policy and the liquidity policy that has been provided to the global financial system by largely coordinated action of the large central banks, and particularly the US Federal Reserve, but also other important central banks such as the European Central Bank. And one outcome of that, of course, is that the crisis in emerging markets has been less severe. So far, we're still in early days. Carmen is right to point to the difference between liquidity and solvency, but so far, the worst fears that were expressed at the beginning of the coronavirus sequence have not materialized in most emerging markets. And that's largely to this internationally coordinated liquidity policy that has been very powerful with considerable market impact. In Europe, of course, even so, there is a lot to be done and a lot of apt frustration at what is not being done. I think it would be misleading to say Europe has wasted this crisis. To the contrary, both in the health policy area and in terms of fiscal capacity with Next Generation EU and the sea change in the architecture of European finance with the large-scale issuance of EU bonds, I think this crisis has not been wasted, and there is a lot to soberly celebrate there. I want to make a comment on financial fragility, not just household fragility, as Maria eloquently reminded us, but fragility at the level of the financial system as a whole, which I think was very much the way Carmen used the word. Financial system fragility is something we are familiar with in the European Union, particularly the Eurozone, from the sequence of the past decade. We've been through it. We can debate when it ended, I would say, late 2016 to mid-2017. In retrospect, but the possibility of financial fragility is very much in the mind of policymakers. What I would like to say is that the worst is not certain. The European Central Bank, and that's a big difference from the previous crisis, is overseeing the system as a whole, and it's so far not been identified as a weak supervisor. I'm talking about, of course, the prudential supervisory tasks of the European Central Bank. And I think they're very acutely aware of the possibility and risks of financial system fragility. So I have hopes that we're not going there. There are no signs of it at this point that would be, alarm bells. Capital levels, as is well known, were high at the beginning of the crisis. The European Central Bank has granted capital relief, I think correctly. It has also limited distribution of dividends, I think very correctly, and better in that sense than the US equivalent to enhance capital conservation. There are big risks of credit events in the corporate sector, non-performing loans that would go beyond what has been guaranteed by member states and generate big losses in the banking sector. But when you match that with the capital levels and capital buffers that exist, I think there are a range of scenarios, many plausible scenarios in which the banks have enough capacity to absorb these forthcoming shock without going into zombie territory. So this is obviously a matter of high uncertainty. My message here is that zombification is not a given. It's not necessarily, I don't view it as a baseline scenario in Europe. It's something that policymakers have to prepare for, but it's not something that has to be acted on, I think, preemptively beyond what has already been done throughout last year. Let me add that if we were to enter a situation of systemic financial fragility in Europe, I think we have, broadly speaking, at least from a legal perspective, the tools to address it. What would be needed in that case, and of course, Carmen has an unmatched track record of looking at past episodes of that nature, what would be needed in that case is a precautionary recapitalization of the entire banking system. And we may expand on this in the Q&A. But we have a tool for it, which is precautionary recapitalization. We have potentially financial instruments to do it at the European level. That's either the European Stability Mechanism for the Eurozone or the European Union as a whole, with the new flexibility, financial capacities that is generated by Next Generation EU and the new architecture of EU bond issuance. Of course, it's a matter of political decision, and I'm not downplaying the political difficulty of executing what I'm talking about, precautionary recapitalization of the entire European banking system or Eurozone banking system with European level funding. But I want to insist that this is not a matter of new legislation. It's a matter of political decision and execution, and it's not something that is at all certain to be needed going forward. Thanks again.
Thank you very much indeed, Nicola. Very interesting proposition there. I'm going to ask Carmen to pick up on any of the comments that have so far been made, but also to mix into your immediate reactions a couple of the questions that have come in so far. And there are a couple which are linked. One from Emantas Skeris, I think is the pronunciation, asking about the longer-term impact of quantitative easing and printing money in inverted commas, the implications for prices. Already during the crisis in some countries, there have been increases in property prices and in food prices. I mean, is that just part of the short-term wear and tear, or is it an early sign of something more fundamental? And Andrej Matic asks the question, how much margin is there for further monetary and fiscal easing? And how fearful, without drawing you into sort of market-sensitive comment, but how fearful you are about the possibility of a further financial crash. For those who don't know, Carmen is one of the world's leading experts on financial crises in the past. And so the question is, are there further chapters to be written to your various books? Go ahead.
Sorry. This is, they're very tough questions, of course, which, you know, I'm not surprised given the caliber of these discussions. Let me start, before heading into those two questions, on a point that Nicholas made about fragility. One of the things that concerns me about fragility, it certainly in the EU context, is not the ability to deal with it, should it arise. It's actually that, if history is any guide, whenever balance sheets become somewhat impaired, even if it's not in the extreme danger zone, it has implications for lending standards. Lending typically is curtailed even in ample liquidity situations, and the post-2008 crisis was illustrative. And credit is a big engine of growth for especially in even more so in Europe than in the US, where, it's very bank-centric relative to the more capital market-driven US. So in some cases that I talked about, I used the India example where initial conditions were already problematic and so on. It's a different order of magnitude, but in most cases, even if the impairment in balance sheets is, not of the systemic nature, but of more what one would call borderline type crises, you still worry about new lending, as typically, the reaction is to recapitalize, tighten lending standards, and just become much more cautious in general. And let me turn to the big question on, printing money and when does one see the consequences of this? Well, there's certain consequences that we're seeing right now, and I very much agree with what Nicholas also said towards the, I think, beginning of his remarks, that we haven't seen a worse outcome for the emerging markets because of the ample liquidity. Okay, and that's the positive side, right? I mean, the printing money, the low or negative interest rates, all the credit facilities that are buying corporate debt, that are buying loans, all the injections of liquidity in their various forms have kept at bay what would have been, I think, a much deeper shock for emerging markets, the shoe that didn't drop, if you will. Commodity prices fell dramatically. That's one shoe to drop. Capital flows reversed dramatically, especially in April. That's a second shoe to drop. The shoe that did not drop was interest rates, quite the opposite. However, the downside, and here I'm coming to squarely on the risks that the question is posing, is our ability to project or forecast inflation on the basis of past money growth has been severely impaired for decades, not just for years. So, but what does it do to risk taking, and what does it do to certain relative prices? I think it's pretty clear. I mean, the upside of the liquidity injection is that it helps a lot of countries that would have been frail had interest rates been higher. The downside is that, how does it do that? Well, the search for yield makes many emerging markets much more attractive, and at a time in which interest rate on sovereign advanced economy bonds are, low to negative. So it facilitates lending to emerging markets. So is that avoiding the crisis, or is it delaying it? I don't know. Okay, but I do worry about the liquidity conditions fueling bubbles in equity, in high yield bonds, including emerging markets, and in general also fueling the growth of non-bank shadow banking sector further. So those are concerns. Now, coming to the inflation question, the broader look, I think over the very near term, the aggregate demand shock that we've been discussing, the collapses of 2020, the fact that, recovery in per capita incomes is still, very much a slow moving process, that so much excess capacity globally. I think I'm not looking for inflation down the road. In the shorter horizon, However, what we didn't know in the 60s, and we don't know today, is at what point does, the cumulative effect of a combined monetary expansion without a positive supply shock. In effect, our discussion of COVID is very much focused on treating it primarily as an aggregate demand shock, which it certainly is. But it's also generated a lot of breakdowns in a lot of international supply chains. It's really, caused a certain amount of the world's capital stock in airlines and in the entertainment and in tourism industries to be obsolete almost overnight. And so it has big supply shock elements. We know with the hindsight that the last time we had very aggressive monetary response, the printing of money to deal with adverse supply shock, back in the 70s when it was an oil shock, easy to see. Now the supply shocks are more difficult to measure. It did ultimately mean higher inflation. So I am not one of the people in the camp saying inflation is dead. I don't think it's likely in the near term. I think the jury is out on the medium term. The question, is there margin for further stimulus? Look, you're asking a question that we continually discuss at the bank because, and I'm not dodging it, it is very country specific. The amount of firepower, of how much ammunition you have left is very connected to some of the issues we've been discussing in terms of this being a very regressive shock. Low and middle income countries some of the middle income countries still have some fiscal space. A few low income countries that entered this with very solid fundamentals have some fiscal space, but fiscal space in the non-advanced economy world is a fraction of what the advanced economies can do, and even in the advanced economies, it's not infinite. And we're at the point where I think there are concerns again for some countries like Greece, like Italy, more than others. I'll conclude by saying that on the monetary policy side, I think where the capacity for further stimulus is more tightly lit is also in emerging markets. Emerging markets, for the first time that I'm aware of in history, have been able to do countercyclical monetary policy big time during this pandemic and lowered interest rates. Now, we've also seen that countries like Mexico and Brazil, which rely also heavily on foreign investors buying domestic currency debt, right? Those foreign investors were buying domestic currency debt because, well, if the peso depreciated or the real depreciated, you still had a very high wedge, a high real interest rate. You had a carry, you had high coupons. Now that those coupons aren't there, external creditor participation has also diminished substantially. So the jury is out on how much of this can carry forward, number one, and more generally, how reproducible is it under different circumstances?
Thank you, Carmen. Thank you very much indeed for that. We've got really little time left. I'm going to take the two other questions which are most relevant that have come in. One is from Etienne Bassot. We've touched on it a little bit, which is how far might the World Bank, in this case, help promote a greater cultural preparedness within the global community? That's very interesting. And Antoine,
could you repeat that? Could you please?
How far could the World Bank itself help promote this culture of greater preparedness, if you like, the notion of anticipatory governance? And then Antoine Ripoll is asking a very topical question right now, which is what prospect do you see for transatlantic partnership, greater transatlantic partnership between the new US administration and the European Union, notably, in trying to go forward on the macroeconomic aspects of management, and maybe also on some of the more technical and medical dimensions. And then after you've answered that, I'm going to give each of the three commentators a chance to come in and make a very succinct final remark. But over to you first, Carmen.
Okay, so very, very quickly, the issue of preparedness, and I think, Lars' comments were also very much on point. That we should have been a lot more prepared. And this sounds like self-promotion, okay? And it has an element, to be truthful, but, the view that this time was different, that, these pandemics don't happen in advanced economies, just as systemic financial crises, let alone defaults, don't occur in advanced economies. And we had those in 2008. Crisis, I think, was a factor. But what is the World Bank doing? I think one new agenda, I mentioned the work on climate change. And climate change is a really big issue, not just from the environmental dimension, from the social dimension. It is a big driver of poverty. And so in terms of resilience, there are areas where I think the bank is moving on. Food security is another one. The pandemic has revealed that real weaknesses in food security when you had both domestic and international disruptions in the migration, labor and in normal transport and so on. So food security is another area in terms of the resilience agenda. And so there's the climate, there's the food security, and I would say that the food security one is the bank is becoming a lot much more proactive in that area, as opposed to sort of coming in when there's an extreme drought or more extreme events, which had been more the case in the past. I think the big challenge is, and there we really have to overcome for many countries the current problems that I described on building resilience, is you want fiscal space. You want space to do, very counter-cyclical, policies in bad times. So rebuilding fiscal space and monetary space will be an important. We're not there yet, but is important on that agenda. On the transatlantic, I think definitely, the international cooperation, Nicholas referred to, which has been working just fine at the central bank level. But then when you get to other fora, we know, it can only improve. So my expectation is one where I'm looking for much more cooperation, Europe-US, where I still think, transatlantic, yes, beyond that, global, I don't think the issues with China are going to change because we had a change in administration. I think those issues, the long list of them, and possibly now even with more emphasis on the environmental issues as well. I think that dimension of international cooperation, it may change with the new administration, but I don't see it as, you know, having the upside as obviously the US European.
Great, thank you very much for that, Carmen. Now I'm going to invite each of the panelists to come in with quick-fire comments, either in response to any of the new questions that were asked or in respect to Carmen's various remarks herself. And I'm going to do that in the reverse order to originally. So first of all, over to Nicola. And if each of you could keep it to, say, 2 minutes, that would be great. So Nicola first, then Lars, then Maria.
Thank you very much. I will make 2 points. One is about financial fragility and the discussion we had about the European Union and the European banking system, because I know this is a matter of interest for our audience. I don't disagree with the point Carmen made about the risk of impaired credit allocation and insufficient lending if the system is in a defensive mode and with the possibility of fragility. I will only observe that we had a boom, not a crunch of lending in 2020 for a variety of reasons. And at this point, there is, I think, very little indication, if any, of credit scarcity in the European economy. So this is something to be monitored. We're still in early days, but the fact that we had a dramatic increase in credit last year, I think, has to be kept in mind. The other point I want to make is about what Carmen just said, and I would go even further. I think today, with the advent of a new administration, marks a sea change in the entire multilateral environment. In the last 4 years, and especially the last 2 years, the agenda for the multilateral community was a defensive agenda of protecting what could be protected of the system against the destructive assaults of the Trump administration. Now we have a completely different landscape where the US administration is oriented towards constructive multilateralist action. That's also the case of the European Union, and perhaps more than in the past with von der Leyen's Commission ambition of a geopolitical commission. And I will note on China that on multilateral issues, they talk the talk. They have the rhetoric of multilateralism to a very significant extent, even with the domestic repression under Xi Jinping. And I think now we do have a certain alignment of US and European position at managing a mix of cooperation on global issues, including climate change, and of course, being in a more competitive environment on other issues, including greater vigilance, probably than under the Trump administration, on human rights. So I'll stop there for the sake of brevity, but I think it cannot be underestimated the extent of change in the multilateral environment that comes today.
Thank you for that. Over to Lars.
Yeah, thank you so much. Just one quick point to add here. I really hope that Nicholas is right, that we will see a surge in multilateralism, because my impression is that you know, with all these global disruptions that we have seen over the last 10 years, we have witnessed a continuous decaying of international cooperation. So one after the other global disruptions, starting with the 2008 to 2009, not global as we have learned, but financial crisis, and continuing with what the popular revolts in the MENA region, continuing with Russia's annexation of Crimea, and of course the Brexit decision and the election of Trump. All this, in my view, led to a really horrible decline in international cooperation, contributed to that. So it appears there's at least a correlation between a major global disruption, because we were not prepared good enough, and that can simply not continue. Thanks.
Thank you, Maria.
Yeah, thank you. Perhaps to add two points on the issue of inflation. Far be it for me to forecast. I have started by saying I don't want to forecast. The markets themselves, both in the EU and in the USA, are not expecting either the nominal rates or inflation to go anywhere up in the next 30 years. But I think what's important to understand here is what is driving inflation to be quite so low. I think this is the point that we need to answer in order to be able to say something about the future. And we can have a huge discussion on this, but I will say the only thing, if the reasons behind the levels of inflation and nominal interest rates and real interest rates and, dare I say, equilibrium interest rates are structural, then there's very little that macro policy can actually do. Either the monetary policy or fiscal policy. We've seen differences between the US and Europe, particularly on monetary policy, but also on the extent of fiscal policy. And yet all the macro variables which are structural, total factor productivity, the labor share, the capital share, they're all declining in the same way. So what is driving this? And if it's structural, then that's the direction of investigation that we need to go. On the transatlantic relationship, I am very upbeat about actually the US now being a much more cooperative partner. What I will say, however, is that the last 4 years have happened. We cannot simply ignore the last 4 years, certainly for the attitude that now Europe has developed. I think the public opinion has made a very stark switch and against the US, which is actually something that, surprising though it may be, or not surprising, it is there. So I think on the point of the EU, we're going to see, also on the rhetoric, but also on action, a lot more of a sort of an autonomous, in line with strategic autonomy attempt to contribute to the global discussion. We've heard the speeches this morning at the European Parliament by the President of the Council and the European Commission. They were going very much in this direction, that we are going to exercise a voice in line with, President Michel said, in line with the true weight that Europe is playing. So it's not going to be the same relationship. I think it's going to be a good relationship, but it will be different. Thank you.
Thank you very much indeed. I'm going to ask Carmen if she would like to make any final closing remarks. But before doing that, just on the point that Maria was making, yes, I think there is this kind of prise de conscience which is taking place inside the European Union about how far we can and should and need to step up to greater global responsibility. That's one of the lessons I think that people have learned from the Trump administration. But on the other hand, America has always wanted a partner that they could deal with and who was serious about exercising responsibility and power. Even if Henry Kissinger famously remarked, I think in 1969, that America has always wanted a more united Europe, but recoiled from its potential implications. So let's see how that balance is struck during the coming Biden administration. Over to you, Carmen.
Well, first of all, I would like to thank all of you for a wonderful discussion. On the issue of globalization, I think I lean towards some of the concerns that, have been voiced. I think, globalization historically has gone in very long cycles. In pre-World War I, it was, we had a much more globalized world that we did in 1950. Globalization by various measures peaked before the 2008-2009 crisis. And, we've had ample waves of reduction in different measures of globalization, also including trade. I think we cannot also dismiss, this goes back to the very first point I made, we're living with a lot of uncertainty right now on what the legacies of COVID. And I think the supply disruptions, the breakdown that we've had in travel, even when things ultimately resume, may not go back to their pre-COVID level. So I think the another form of deglobalization is countries having less access to financing, which has not happened in a wave like it did when Paul Volcker tightened interest rates in October of '79. But it has happened, and it is happening much more gradually. So those are forms of deglobalization. In other words, I expect much better outcomes in terms of the global discourse and cooperation between the US and Europe, to be sure. Whether we're, going gung-ho again on, the globalization cycle. I don't think we're there yet. I think, periods of prosperity tend to be big propellers for globalization, and we're not exactly in the midst of a rip-roaring prosperity at the moment.
Thank you very much indeed, Carmen. Thank you also to Nicola, to Lars, to Maria for sharing your reflections, your thoughts, your insight on this really absolutely central issue. And everybody stressed the degree of uncertainty, but I think at least coming out of the discussion, we understand some of the dimensions of that uncertainty much better than we did before. So thanks once again. Our next EPRS roundtable will be a week today, and it'll be on the first 100 days of the Biden administration. So we look forward to as many of you as possible joining us on that occasion. We had, I think, at one point 125 people online, and it's a great start to EPRS roundtables for this year, 2021. Thank you very much, everybody, and goodbye.
Thank you. Bye-bye.
Bye.